Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 32 of our YouTube channel and podcast, and I could not be more excited to continue talking to you guys about different personal finance topics and things that are hopefully going to help you through navigating your personal financial life. Today, we are continuing talking about the things we can invest in, and not just the accounts, but the things that go in the accounts and the particular types of investments. And so today what we're going to focus on are bonds. And this is a topic that is extremely interesting, and you're going to hear a lot of opinion from me, but you're also going to hear a lot of just straight fact about what bonds are, how you can use them, and the part that they may play in your investment portfolio. So we'll get into that today. But before we get started, go down below, click the subscribe button. If you're on Apple or Spotify, subscribe to the podcast there. Also, like this video if you could. Leave me any feedback as we go along in the comments. I'd be glad to talk to you guys and start a dialogue with you about the things that you may have questions about, or just anything regarding the particular topics that I'm going over. Also, follow me on social media at MNO with Dylan. That would be really useful to you guys because I put out a lot of content there, and just a lot of little tidbits and tips and tricks and facts that may allow you to grow your financial life in a way that maybe you don't get from these videos. Maybe these videos aren't the way that you learn. Maybe you'll learn more visually by those things. So go and follow me there. Also, if you want to work one-on-one, face-to-face, or virtually, however, just one-on-one, dealing with your financial life and building you a financial plan, then we can do that. But I need you to go to my website, www.mnowithdylan.com, and you can learn more about the services that I offer there. So let's dive right into today's topic of bonds. So what are bonds? You may have heard the word bonds before. Your mom and dad may have bought you savings bonds when you were born, or your grandma may have bought you a savings bond or something. But what's a bond? What is this? Well, simply put, a bond is debt. You may say, well, debt? Then why is that valuable to me? Why would somebody buy me debt? Here's why. Let's say a company needs to raise money. We talked yesterday about how there are three ways that a company can raise money generally. One is via the money that they already have, the retained earnings, they call it. So profits that they've kept over time, they can dip into those and just pay directly for whatever they need in their operations. They can also sell shares of stock, which is what we talked about yesterday. And that's selling ownership in their company for some value, for some amount of money. Then there's this third way, and it is by debt. Well, one thing that they can do with debt, they could get a direct loan from a bank, or they could do some more kind of direct financing with debt. But something that a lot of larger firms do is they issue bonds. And what bonds are, let's just use this example. If you needed $1 million as a firm, okay, and you didn't think you could get $1 million from just one place, and so you decided to issue bonds. Well, what may happen is you may split that $1 million into $1,000 increments, which we will call bonds, so $1,000 increments of debt, and sell them to the public, firms and individuals and investors, right? And these firms and individuals, these investors, will purchase the debt with some promised return behind it. So instead of getting a loan from a bank, what's happening is these individuals or these investors are loaning you money, but just loaning it piece by piece. So instead of $1 million one time, you get $1,000 1,000 times, and that's going to give you your $1 million. And so that's how a firm may raise money when it comes to a bond. And you can see there how an investor may make a return via bonds because you are lending money. And what do lenders do? Lenders charge some interest rate. And so that interest rate will be inherent to that bond. And we'll talk more about that here in just a second. Now, bonds have a few different components that we may want to talk about here. First, there's the face value of the bond. And so most bonds have a face value of $1,000. And this means that the value of that bond is $1,000 when it matures, when it finally is done, when it is completely due, right? Then there's also a maturity to a bond, like I just said, when it matures. So bonds can be different lengths. They can be 1 year, they can be 5 year, 10 year, 20 year, 30 year bonds. That means that you're going to get paid back over that course of time. Then there's a yield or an interest rate that is tied to a bond. That's telling you what your return will be over the life of the bond. So what your annual return will be. And then there's also, in many cases, what's called a coupon rate. And this coupon rate is a part of your total return, but it tells you how much you're going to make in just direct interest payments. So what do I mean here? I mean that every 6 months or every year, depending on how the bond is set up, they'll pay you some percentage of that face value in interest payments. That way you're making a return as you go. And then what happens with a bond is you get paid the complete face value back at the end. So you may be making these coupons as you go, but then at the end you get paid the entire face value. And so this is how you're going to make your return on a bond. And when you purchase it, you're not purchasing it at the face value. You're purchasing it at whatever the market price is, which could be above or below face value, whatever it may be. But those are the components of a bond, and that'll help you to understand what I mean as we move forward. So your return on a bond does not differ based on the success or failure of a company. Now, when I say success or failure, I mean marginally. I mean, if the company is losing money, that doesn't necessarily mean that your bond is not going to pay you the return that it promised. Or if a company is making a lot of money, you're not going to get a higher return from the bond that you purchased. Your return over the maturity of the bond is going to stay static. It's going to stay at whatever the stated yield was. Now, let's say a firm were to go bankrupt. Well, then that may have some bearing on your ability to receive returns for your bond. And so that could be an issue. But just marginally, just on the year to year, doing good this year, doing bad this year, that should not affect the return that you get from a bond. The return that you get is locked in at the buy if you are to hold the bond all the way to maturity. So it doesn't matter the fluctuations, the short-term fluctuations in the firm. Your bond should still return what it says it's going to return. Now, you can sell a bond before it matures. Of course, you could do that, and that might help you get a higher annual return in the short term, but you're not going to get that return after that point that you would have gotten if you would have held the bond all the way to maturity. And so as an investor, when you purchase a bond and you see that yield that you're going to receive, that yield is typically not going to be, on average, more than what you could make with stocks. Just in general, the historical returns on bonds have not been as high as the historical returns on stocks. And it makes sense, right? Because if I'm a firm and I want to increase value, I want to increase the value of the firm. If I'm a manager of a firm or a CEO or something, and I want to increase the value of my firm, well, a way that I may do that is by, let's say, opening a new manufacturing unit or opening some other facility that would increase my capacity, my ability to make things, right? Well, I may do so by taking out debt. So I may take out debt in the form of bonds in order to fund this operation. Well, if I issued bonds and I had like a 4.5% interest rate on the bonds, right? Well, it would be dumb for me to build some manufacturing unit or something that is going to make less than 4.5% in firm value increase because I just had to pay 4.5% on that money that I borrowed. So it would naturally make sense that the value of the firm should increase more than the cost of the debt that you issued in order to raise funds, because if not, you'd be going backwards. You wouldn't be able to keep up with the liabilities that you were bringing on. So it makes sense why bonds don't perform as well as stocks historically. Now, the thing about bonds is that their returns are predictable and they do come ahead of shareholders or stockholders when it comes to firms being in distress. They will receive money first because they are creditors of the firm. They have lent money to the firm. So they're much more likely to receive money back from the firm because it's fixed and predictable their return is. Now, a lot of people think of bonds as safe, and that's not a word I would typically use. The bond market is extremely volatile in the price fluctuations and the interest rate fluctuations. The bond market is volatile, but a lot of people see that firms are going to do their best to make their debt payments, and if they can't, then they'll go bankrupt. So they want to remain what they call a going concern. They want to keep operating in the way that they are. The way that they would do that is continuing to pay their debts. Therefore, it's seen as a safer return than what you can expect from stocks. So I just touched on a couple of these concepts, but what is good about holding bonds? Like, why would you be interested in holding bonds? Well, the fixed and predictable returns are something that really draw a lot of people to bonds. And it's a reason that over the long term, people have historically held corporate bonds and government bonds for themselves because it's fixed, it's predictable. They know they're going to make this return over the long term, and they're okay with that. And so that's something that can be good because you can have a piece of your investment portfolio that is fixed and predictable. Now, another good thing about it is that if I hold a bond and the firm goes bankrupt, like I said a moment ago, I'm one of the first up to receive money. I'm one of the first up to receive the money that I invested back, the face value of my bond back. And that's going to put me in a stronger position than a shareholder if a firm were to go bankrupt or to be negatively affected by some economic something like a coronavirus downturn or something like that. You see a lot of that nowadays, like with firms that are going bankrupt due to the coronavirus. Well, they are having to renegotiate their debts with their creditors because they want to stay open. They want to keep doing what they're doing, and the creditors want to get paid. And so even though the creditors may not receive exactly what they were promised in return, they're going to receive far more than a stockholder might. And then this last reason is not something that I've covered yet, but it's extremely important, and it's something that you should keep in mind. And that's why we may want to hold bonds in a portfolio. It hedges your equity holdings, or it hedges your stock holdings. So how can it do this? Well, bond prices run inverse to interest rates. So as interest rates drop, bond prices are going to increase. Well, in a similar way, stock prices go up a lot when interest rates are low because it's cheaper for a firm to borrow. Now you may say, well, that didn't sound like a hedge, Dylan. That sounded like the exact same thing going on. Well, let's say interest rates dropped. Well, when interest rates dropped, the price of the bond went up. Well, if you were to purchase the bond and the stock in a low interest rate environment, then what you're going to see is you have a much lower yield on the bond than you did in a higher interest rate environment. So your return is going to be lower. That's what happens when a bond's price increases. That sounds good. And it's good if you're holding it or trading it, but if you're holding to maturity, a higher bond price is not a good thing because it's going to bring a lower yield, a lower return. Well, with stocks, they're going to thrive in low interest rate environments, and because it's cheaper for the firms to borrow. And that statement right there tells you don't want to own bonds because it's cheaper for the firm to borrow, which means when the firm may issue bonds, they don't have to give a high return to investors. And so it hedges your equity holdings in that way because let's say low interest rates, well, stocks are going to thrive and bonds aren't going to do very well. And then in a high interest rate environment, then bonds are going to thrive and stocks are going to have a harder time because it's more expensive for firms to borrow. And so you see how they work kind of contrary to one another. So it can hedge those holdings. It can take a little risk off of your portfolio by having a different correlation of returns. And we've talked about that before when we've talked about risk and return and diversification, asset allocation, things like that. So what are some reasons not to own bonds? Well, one of the first would be downgrades and default risk. So if a firm is doing worse and they're struggling to pay their bills, well, they may get downgraded by these credit rating agencies, basically saying they aren't as good at paying their bills as someone else and they're not as likely to pay their bills as someone else. Well, that's going to really hurt the value of your bond holdings. Now, like I've said before, returns should stay fixed, and they will stay fixed if you hold to maturity and the firm doesn't go under. Then you will receive that fixed, predictable return. But if you are trying to trade bonds or have the value of your bonds go up so you can sell them, that's going to really hurt you there. Then there's inflation risk, and this is a big one. This is a big reason not to hold bonds in many cases, because what inflation does is it eats at the value of money over time. Well, you may say, well, that's not a big deal, Dylan, because I can just make a return that's higher than inflation, right? You can. The problem is that you're receiving a fixed return, and any fixed return is going to be eaten away by inflation at a higher rate than does a variable return, or a return that is more dependent on economic conditions, like a stock return, right? So stocks allow you to hedge against inflation. It allows you to grow more than inflation grows to still get good real returns. But bonds don't do that because the return is fixed. And so it's going to eat away at the value of bond returns. And so that's a risk to bond investing. And then further, there's interest rate risk. We talked about that, right? As interest rates are very volatile and a lot of times, and the value of your bonds can go up and down quite a bit, and that can impact the value of your portfolio. And so that's something that may not allow investors to sleep too well at night, because interest rates are very volatile, and so are the prices of your bonds over the long term. Then there's also liquidity and or call risk. And so this is what this means. Liquidity risk is the risk that you can't sell your bonds for a good price, for an efficient price in the market. And that may be because there's not a lot of demand for a particular firm's bonds, or there's not a lot of supply. If you're looking to buy, you may not be able to buy at an efficient price. So there's some liquidity risk there. Then there's also call risk. A lot of bonds are what they call callable, which means that a firm may choose to call their bonds, meaning go ahead and repay their investors early. That way you don't receive the yield over the longer period of time. Your yield gets cut short by the fact that they called the bonds. Now, they usually do so at a premium to face value. Therefore, you receive a little bit more return over the course of the time that you held it. But if it's a 10-year bond and they call it after 3 years, you missed on 7 years of returns that you were expecting to make. So that's where call risk comes into play. And then just based solely on returns, we're not talking about bringing risk into the relationship right now. But if you just look solely at returns and you look at a total stock market index return and you look at the total bond market index return. So I'm looking at two ETFs here. I'm looking at the Vanguard Total Stock Market ETF, VTI is the symbol, and I'm comparing it with the Vanguard Total Bond Market ETF, which is BND is the symbol for that. Well, from April 1st of 2007 to June 1st of 2020, the annualized return on the VTI, the total stock market index, has been 7.87% annually. Okay, not bad return. Okay, but on the total bond market index, the return has been 4.45% annually. And so that's a 3.42% premium on the stock portfolio annually. And that's a big deal when it comes to wealth building if all your money's in bonds versus all of it in stocks. And I'm not saying that either one of those are completely correct. I'm just saying that the returns that you can receive on the total stock market index are going to be greater. And we talked about why that was earlier, because you want to borrow at a lower value than the increase in value you look to make from borrowing money as a firm. So it makes sense why stocks should return higher than bonds of the same firm should. And what's interesting about that little time period that we looked at, it was from April of 2007 to June of 2020. Well, in that time period, there were two bear markets, two major market crashes. And what do people say about bonds? Oh, they're so safe. They'll provide you with good returns when the market turns downward. Well, this took into account both of those crashes, and the stock portfolio still beat the bond portfolio by over 3%, which shows you that even in bad times, even through bad times, those stock portfolios are still going to do quite well relative to the bond portfolios. So me personally, if I can pick up that 3.5% per year just by sticking it out in some tougher economic times, then I'm going to do that. Like, that seems like a good value proposition to me, but it may not meet the risk portfolio of everybody. So I don't want to speak for everybody. I'm just saying, for me, I'd rather pick up that other 3.5% difference than put too much of my money in bonds, especially at my age and my risk profile. So am I saying to never invest in bonds? Am I saying that this is not a good investment vehicle? By no means, not what I'm saying. I'm just saying it must meet your risk profile. It must meet your ability to take risk and hedge your returns in the way that you feel necessary. Now, I believe you can go too far. And the reason for this is something that we spoke on yesterday, is the 10-year rolling returns on the S&P 500. And when I say rolling returns, I mean like 10-year periods from 2000 to 2009, and then a rolling return would be, okay, then the next 10-year period, 01 to 2010, like that, and right on down the line. And so if you look at 10-year rolling returns on the S&P, just like we said yesterday, right? The worst 10-year rolling period on the S&P from 1871 to 2020 is negative 4% annually, which, yeah, negative 4% annually, that's not very good. But let's look at what the average 10-year rolling period is. It's 10.2% annually, and the maximum was 21% annually. Those sound good to me. I like those returns on the S&P versus what I may pick up in the bond market over the long term. Now, when it comes to creating income, bonds are a phenomenal investment choice if you're trying to create income from them. Why? Because they can pay you those coupon payments that we talked about earlier, those interest payments that come semi-annually or quarterly or annually, however the bond is set up. And they can do really well at that. They can provide you with the income you need. So if you're in retirement and need income creation that is a bit more stable, then bonds may be your way to go for a certain percentage of your portfolio. If you are maybe somebody younger, not in retirement yet, and you're taking income off of your investments already anyway, then bonds may be a particular place you want to put some of your money in order to create that steady income stream if you're trying to create more income streams. And that's a really big use of bonds. That's why a lot of people have them and like them, because they do provide those coupon payments. But just remember the inflation risk that we talked about earlier, and how those coupon payments are decreasing in value every single time that you get paid because of inflation. Now, I would say that one of the worst things you can do is attempt to trade bonds, because they are volatile and interest rates are volatile and the price of bonds are volatile. But if you hold bonds for the long term, you can get the fixed, predictable returns that are really going to help your portfolio, and it's going to allow you to long-term hedge some of your equity risk if you so choose. But I'm not saying you have to. I'm not saying you have to hold bonds or you should hold bonds, because you can give up a lot of returns, especially younger people. If you're giving up 1% in returns, you're giving up a lot. If you're giving up 1.5% in returns, you're giving up a lot. So I don't want you giving up too much in returns just to hedge some of your risk. Be willing to take some risk early on in your life. That way, later on, when you get to this point of you're just capitalizing on what you have and you're getting close to retirement, then maybe then is the time to take more risk off. I mean, I think if you're in your 20s, this is just my personal opinion, there's no reason to hold bonds. We don't need to hold bonds in our 20s. That just doesn't make any sense. I think if you get into your later 30s, you get into your 40s, maybe you have a small bond portion of your portfolio, and you can hold bonds just like you can hold stocks in mutual funds and ETFs, and they just, instead of buying a bunch of stocks, they buy a bunch of bonds and hold them in those funds, and you get the average return of all the bonds in that fund. And that can allow you to take away from some of the volatility of the individual bonds, but interest rates are still going to fluctuate, and they're going to have an impact on the value of your bonds over time. So you have to just know that. But I really think bonds are the way to go for individuals who are really pushing into retirement and want to create income. Now, if you're struggling to have the returns that you need going into retirement, too much in bonds may just hinder you. But if you have the nest egg that you need and you know that I can make a 4% return on bonds, and that's going to provide me the income that I need, or most of the income that I need, then bonds can be a perfectly good way to create income. Just be aware of the inflation risk. That's why I don't think you should ever take stocks off of the table. Just maybe hold lesser percentages at certain points in life when your risk profile is saying, I don't need to. It's too risky for me at this point. Too much fluctuation in price and value. So just keep those things in mind, and just know that I'm not saying that bonds are bad. I'm not saying that. I'm just simply saying that if I can get the returns that the stock market is going to allow me over the long term, and that can be the vast majority of my portfolio for 20, 30, 40 years, then I want it to be. I don't want to settle for lower historical returns just in the name of decreasing some risk. I'm just not interested in that. Some of you may be, and that's okay. You should talk to an investment advisor about that, and maybe you guys can set up a portfolio that's right for you. But if you're young, I just implore you, get the stock returns. You can get in bonds later. You can be a little more predictable later, but you have time. Those 10-year rolling periods tell the story. Listen to this video again and remind yourself why. So ultimately what we're getting at is that bonds aren't as necessary as individuals make them look, but they do hold their place. They do have a place in the investing world. That's why so many people take advantage of them and use them. But you just have to use them efficiently and effectively within your investment portfolio, and don't take too much away from the returns that you could be earning. That's all that I ask. Make the returns that you can make within your risk profile and maximize those with the lowest fees and the lowest cost that you can, and don't allow the fixed returns of bonds to get too much eaten away. If that's all that you're holding, then your money can get eaten away a lot quicker. So make sure that you have some value of your portfolio that's increasing as the economy grows, as the stock market increases. That's just going to benefit you long term, no doubt about it. So hey, thanks for watching this video. I really appreciate all of you guys. Don't forget to subscribe, like this video, leave me feedback in the comments about bonds or stocks or your portfolio or whatever, and we can have a little conversation. If you're listening, thanks for listening on the podcast. And if you would like, go ahead and subscribe on Apple or Spotify podcasts, or even if you're watching this video and you want to go there and subscribe there and listen there, then that'd be great. That's awesome. We just want you to get as much of this free content as you can. And when it comes to free content, there's really nowhere better when it comes to me and what I put out than my social media accounts at MNO with Dylan. And man, there's just so much good stuff that I'm putting out, and so much good learning material that will just allow you to learn about personal finance topics, learn about investing, learn about budgeting, learn about getting out of debt, all those types of things, and do it in a very concise manner. And so you can check those out there. Also, if you want to work face-to-face, you want to start a relationship about your personal finances and creating a personal financial plan, then go to my website, www.mnowithdylan.com, and sign up for a financial coaching session. And we can definitely do that. And maybe that's what will work best for you and your financial life. So you can find all that there. And tune in tomorrow as I really dive into something that I have time and again talked about. And I talked about today, and I talked about yesterday. And that is mutual funds and ETFs. I'm really going to break down mutual funds and ETFs because they should be, and they are, such a big part of the investing world and of individuals investing for different reasons in their life. So check that out tomorrow. That's really going to be a useful conversation and discussion that we have about fund investing, mutual funds and ETFs. Also, check out this weekend. I'm putting out clips now, not doing the weekly rewinds, but putting out clips of the videos that I do throughout the week. That way you can get a little taste of the main topic and then maybe go back to that video if you want more details. So you can check those out on Saturday and Sunday of this coming week. So hey guys, thanks for watching this video. Thanks for watching this episode of Money's No Object. I am your host, Dylan Howell. God bless.